Good evening, friends. This is Rahul Magan here as a Group Chief Executive Officer of Treasury Consulting and also a venture capitalist. Today, I am going to be shoot very important topic which a lot of people are asking from me. How exactly you do the valuation of a startup. So we're going to talk about how exactly you do a valuation of a startup. Now, we need to understand that startups can be divided into multiple parts based upon the how they do the business. So example, they can do the business in the technology, they can do in the food and processing, they can do business in the shipping, they can do in the financial markets like we do, although we are not a startup anymore, and so on and so forth. Today we will speaking about those who are no more startups, but they have reached to a level but still are in losses. So practically speaking, we are covering about how to value a company who's into the deep messes, and I'm not worried the name which I am taking here because these names are in the public domain. So let's take an example of an incident that has happened few days ago, whereby we are having one company which is Lyft. Lyft is a technological internet company, and they just did the IPO and they reached to a valuation of closer by $30 billion as far as the media report is concerned. But apparently, if you look like their annual report, you would get to know the numbers which we have in the public domain. You would get to know that they are having the annual losses tune up to $1 billion. Now there are two ways of looking at it. Number one, I fail to understand one thing, although I am also a venture capitalist with 1 million Singapore dollar of fund, that why venture capitalists are continue to fund these companies who are in the mess. How long we continue to believe that if we continue to fund this company and over the time they would be in the profit. If you are not in a profit within a very first year, you cannot be the profitable even it is 100 years down the line. Second example is the Paytm, which is again in the mess. There are numerous examples. You have so many examples. You have Paytm, Flipkart, Snapdeal, Jabang, Myntra, Lenskart, Quicker. Now you have Lyft. You have Chaiwala, Chai Point. You have so many companies who are around in the venture capitalist domain. You can term this as a startup, you can term this as a mature companies, but they are in the less. Now, how to value them? There are two ways of valuing. Now, since they are in the losses, you cannot value them from a profit side. They are in the losses. We know that Paytm is having a loss of 2,000 crores, while Uber is in the loss, Ola is in the loss, Snapdeal is in the loss, Flipkart, Myntra, Jabong, Quicker, you just name them. Since they are in the losses, the only way to measure them is using the revenue multiples. Since you are able to measure using revenue multiple, this is what industry feel that you can measure them using a revenue multiple, but I tend to disregard. I think the best way of valuation of these companies is once again using discounted cash flow approach, but there is a difference. There are two sides of the coin. So one fraternity or one school of thought believe that we should measure using revenue multiples and we should compute the valuation of revenue multiples. I tend to disregard. I feel that if you computing using revenue multiples, then what about the profitability? Today I start selling one product of Treasury Consulting at $10. I might get a revenue of $100 million in 2 years, but my company would be in the loss of 80 million. What do? Let's take an example of Ola and Uber. Together, Ola and Uber are losing more than $2 billion per year. You would be surprised to know that Uber Eats, which is one of the food companies, Uber launched, and just to show them Swiggy and Zomato. How can we forget the loss-making companies Swiggy and Zomato? They also launched their such ventures. Now Uber is selling that venture of Uber Eats and they are looking for an investor who come and buy. God knows what the people have in mind when they launch the company, and now they are selling it not more than 5 months after the start. Now the question here is that there are two approaches of valuing it. One approach, which is the so-called B schools, business schools are teaching, which is who are paid. Now what these B schools are teaching, they are teaching using the revenue multiple. But I tend to disregard that. If you are taking revenue multiple, then you cannot take the right balance because you are in the net loss. My way of valuing is using the discounted cash flow approach, and in this discounted cash flow approach, we should calculate free cash flow to firm. You know that free cash flow to the firm formula is EBIT, which is operating profit, earning before interest and tax, into 1 minus ETR, bracket close. ETR stands for effective tax rate, minus bracket open CAPEX, capital expenditure, minus non-cash. There are many intelligent people who still writing depreciation and amortization. The right is the non-cash, because there are 5 types of non-cash. I hope you know. And I would open the bet of 100 Singapore dollar if you give me 5 non-cash items in the books apart from depreciation and amortization. Let me see who knows better. The most important component is a delta non-cash working capital. We need to compute non-cash working capital. Gone are the days when the world relied on the working capital. Now you have a non-cash working capital. Non-cash working capital is the difference between non-cash current asset minus non-cash current liabilities, and we need to compute the delta, which is last year minus current year. Once we get the free cash flow to the firm, I would like to give you a small case study to do that. If you open the Paytm financial statement, you would get to know, or the Lyft financial, you would get to know they are having a loss of $1 billion, which apparently is the net loss. But if you do the free cash flow to the firm, you would get to know that the loss is more than to the tune of 1 billion. It might exaggerate to $1.2 billion. So actually it's a cash flow. So let me give you a simplistic example, which is profit. The profit is if you are billing 1 rupee to your client, or $1 or 1 Sing dollar or 1 GBP or 1 Swiss franc or 1 Japanese yen to your client, how much money you are end up saving after all, which is minority dividend, which is taxation and everything. This measure is known as free cash flow to the firm, because something which is coming or coming by. So please remove this idiocy from the books and kindly change it out. What change we need? We need no revenue multiples. We need free cash flow to the firm. There is an argument which business school professors make. They say that free cash flow to the firm is relatively negative. Since you are in the net loss, what is the use? The right is that you would get to know if the loss is to the tune of $1 billion, then the free cash flow to the firm losses to the tune of more than $1 billion. You will get the realistic picture of the company. Now if you compute the revenue multiple, you always end up as a losing. Example, Lyft, let me give you an example of Snap. Snap IPO was at I think $22 and today it is at $11. It is 50% of the IPO price. If I'm not mistaken, Morgan Stanley was an investment banker who valued the Snap, and he valued Snap at $28 at the time of IPO, and today the same share price is ticking at $11. So I again repeat, $22 was your IPO price. Then Morgan Stanley predicted a buy call. He said it is 28 and now it is $11. You can very well see that. This is known as affiliate analyst versus independent analyst. We would have a separate video about affiliate versus independent analyst in the investment banking section. But to wind up this video, we need to understand that if you are doing the business valuation, the right approach is the free cash flow to the firm. And before that free cash flow to the firm, the right approach is to compute the non-cash working capital. I would request all the people, those who really wish to value a startup, and if this startup is having financial numbers in place, well, there are many people who come to us and say that this startup do not have financial numbers in place. Then in that sense, there is a need, there is a procedure. You can have the projected financial number in place, and that is known as CMA, which is continuous monitoring activity on our fixed income platform, www.fixedincome.global. You can visit and download the CMA, or you can mail us. We will give is absolutely complimentary, no charges. So to wind up this discussion, if you really wish to value the companies, those who are in the losses, one way is the so-called revenue multiple method, which these B schools or these investment bankers are accepting. They will give you valuation, but at the end of the day, you are bound to lose. Another right approach, according to me, which is little controversial and always we challenge the status quo, which is free cash flow to the firm. Since you compute using free cash flow to the firm, you will really get to know that company who is in the net loss to the tune of 1 billion like Lyft, but actually the net loss is more than $1.2 billion. This is the right picture. Boss, if the company is not in the profit, there is no need of a valuation. At the end of that, I would like to give you 5 to 10 minutes about something which is OYO. OYO is into the hospitality business. Like there is a news which is coming in the market that OYO has raised Series E funding. I think Airbus investing some amount of money, and now they are a unicorn. Unicorn means their valuation is more than $1 billion. I would like to end this video, ask a simple question from all of you people, those who are into the valuation domain or wanted to be in the valuation domain. Just tell me about a company whose sales is 320 crores. So in Singapore dollar terms, it is closer to 62 million dollars. Who is having a loss of 102 crores? In Singapore dollar term, which is roughly 20 million. So sale of 62 million dollar, loss of 20 million dollar. It means your cost is closer to 72 and more. You are burning cash. And how can you be a unicorn of $1 billion? We would have a special video soon this Saturday, Sunday, wherein we would be talking about is the venture capitalists across the globe are running a Ponzi scheme. Can you tell me one venture capitalist who really don't want you to make the money? How can you name this company as a unicorn? We are not against OYO, but in fact all the companies of the globe, those who are in the losses. So after several years of incorporation, somehow you reach to the profit sales of 320 crores, which is 62 million Sing dollars, and still you are at the loss of 102 crores. Let's take an example of Swiggy, take an example of Zomato. You would be surprised to know people are funding them and they know that they are in the loss to the tune of more than 500 million, which is 100 million Sing dollar. So 100 million Sing dollar is the loss of Swiggy and Zomato independently. And how can you term them as a unicorn? I would like to end up this video with two comments. I think the world as a setup has lost the understanding of business valuation. We are totally lost it that how exactly business valuation work. Last but not the least, we fail to understand that these so-called business schools, they are not practical. Had it been all the professors, those who are teaching at business school, they would be the CEO of some companies. Some would be the CEO of Google, some would be the CEO of Microsoft, but they are not, because they are not practical people. How to run business practically is different than what has been taught in the business school. Last but not the least, how can you define a unicorn if you are not in a profit? The right unicorn is the Facebook, Microsoft, Google, Accenture, Cognizant, Genpact, those who are in the profit. I would like to end up this video with a simple question that if tomorrow you will get to know about a company whose top line is approximately 200k Singapore dollar, while their profit ratio is more than 40 to 50% net profit, it means that that company is unicorn. If we can have OYO, which is closer by 320 crores of sales while 102 crores of losses, they are unicorn, then this company is more than unicorn. So business valuation is an art. It is changing and you need to change. It is not a science. So I request people, do not make this as a science. And while how to value a startup, there is a separate Excel file which is available on our platform www.fixedincome.global. You can get to know from here you can value the startup. Of course, lot of series, lot of videos would be coming at how you can value the startup. This is just a start. But we at the end do not want you to make any disclaimer. We don't mind any business school who is watching this video not feel good about us. That is their problem. We don't mind the so-called companies lift and anyone don't like our videos. That is their problem. The question is, what are we getting valued? How are we getting valued? This is not right approach. Valuation is actually on profits. Valuation is not on the losses. So let's take an example. Since inception, Lyft, Paytm, Quicker, Zomato, Swiggy, Lenskart, Mantra, Chaiwala, Chai Point, and many US companies, they are in the mess. It effectively meant that if they are unicorn, then what about Apple? What about Google? What about Microsoft? They were in profits as early as possible. They incepted. Why we always quote an example of Amazon? See where Amazon reached. Did you reach at that point of time? Did you reach at that level? Ask questions before business valuation. Don't be in an idiotic world. Do not that we tend to forget questions. Else you would be again high flex. With this, we would like to thank you very much. You know my mobile number 919899242978. My fixed income platform www.fixedincome.global. Have a great day ahead.